Lesson 11-3 is accounting for the declaration and payment of a dividend. And what I'm going to do is explain the relationship between retained earnings and dividends and account for the declaration and payment of dividends. The owner's equity account for a corporation are listed under a major chart of accounts division called stockholders' equity. And you can see in the corner there, this is our stockholders' equity. And you can see that we are going to talk about a couple of these accounts that are in here. The only one we're familiar with is basically our income summary. Most corporations have many stockholders. It's not practical to have a separate owner's equity account for each stockholder. Instead, a single owner's equity account titled capital stock is used for the investment of all owners. So when people invest into your business as a corporation, the total amount from all investors is your capital stock. Net income increases a corporation's total stockholders' equity. Some income may be retained for the corporation for business expansion. An amount earned by a corporation and not yet distributed to its stockholders is called retained earnings. Retained earnings is the stockholders' equity account used to record a corporation's earnings. So this is the total amount of stocks for our investors. And if you look at it, amount earned by a corporation and not distributed to its stockholders' equity is it retaining. So the profit they earn is your retained earnings. And they're going to take some of this and give it to their stockholders. But it is in retained earnings to start with. Some of the corporation's income may be given to stockholder as a return of their investment. Earnings distributed to stockholders are called dividends. A corporation's dividend account is a temporary account. Each time a dividend is declared, the stockholders' equity account dividends is debited. At the end of each fiscal period, the balance of dividends is going to be closed into retained earnings. So you're going to keep them separate. Okay, our dividends is what we plan on giving our stockholders. Okay, and we have to keep track of it. Dividends has a normal debit balance. Okay. So if you take a look at it here is our stockholders' equity. This is the total amount of our investors. Retained earnings represents basically the profit that we made during that fiscal period. And dividends is what we plan on giving back to our investors. And it's not going to be the same as our retained earnings. We're going to decide how much is going to be given back to our investors. A group of persons elected by stockholders to govern a corporation is called a board of directors. Dividends can be distributed to stockholders only by a formal action of the board of directors. So the board of directors decide how much they are going to pay in dividends. Action by the board of directors to distribute corporate earnings to stockholders is called declaring a dividend. Dividends are normally declared on one day and then paid at a later date. So you get a board of directors. It's usually an odd number, 5, 7, whatever the corporation decides. And then the board of directors will look at the retained earnings to see how much is in there. And then from there, they're going to decide, do we need to keep some of this money for expansion? Do we need to keep X number of dollars for this or that? And then they will decide how much they are going to declare as dividends. And this all happens on one day. And then later on, they're going to take the amount that they've declared and they're going to pay it. It's not on the same day. They don't pay and declare on the same date. Not all corporations declare dividends. Again, a corporation board of directors must consider how the dividends impacts the corporation. When the dividends are declared, the corporation is obligated to pay it. So once they've decided that they are going to pay dividends, they are stuck with that. They have to pay them. The dividends is a liability that must be recorded in the corporation's account. And it's going to be a liability because they have to pay, once they declare the dividends, they have to pay their stockholders. So they owe that money to the stockholders. A dividend cannot exceed the balance of retained earnings. So whatever you make in retained earnings, your dividends have to be either that or less. 3 Green's board of directors declare a dividend every 3 months so that its stockholders can share the corporation's earnings throughout the year. 3 Green declares dividends each March 15th, June, September, and December. On those dates, that's when they decide that they're going to declare their dividends, whether there's dividends to declare or not. The dividends then are paid on the 15th of the month following the declaration. So if they declare dividends on March 15th, they will pay them on April 15th. So they get them a month to get them all taken care of. Here is a transaction declaring a dividend. December 15th, 3 Green Board of Directors declared a quarterly dividend of 5 cents per share of capital stock issued is 75,000 shares. Total dividends, $3,750. Date of payment is January 15th. Memorandum 43. A lot of information there. Okay, so we have our accounts affected. We have our dividends and dividends payable. Remember now, this is just declaring a dividend. We're not paying them right now. Our board of directors is saying this is how much we want to declare in dividends. And they decided that they are going to give every stockholder 5 cents per share. And the total amount of all their shares, if you take that times that, you come up with $3,750. Okay. So our dividends is going to go up, and our dividends payable is also going to go up because that is the total amount that we owe all of our stockholders. When we record it in our journal, we write the date, the account debited, memorandum number, debit amount, and credit amount. And again, dividends has a normal debit balance. You'll increase that. Dividends payable, this word payable means it's a liability, and that's going to also go up. Paying a dividend. Now it's a month later, and they are going to pay their dividends. 3 Green issues 1 check for the amount of the total dividend to be paid. Most corporations make a check payable to an agent such as a bank. Then the agent, like the bank, will handle the details of sending dividend check to individual stockholders. You might have 2,000 stockholders. So what's going to happen is you write out a bank to somebody that's going to make payments for you. Okay, so you might write out a check for the whole amount to a bank, and the bank is going to write out the check or make electronic deposits in those 200 or 2,000 stockholders' accounts. Okay, so you're not going to write out the check as a business. You pay for that to be done. Okay, so paying declared dividends, notice the date is now a month later. We're going to pay cash for quarterly dividends declared. Okay, and you can see how they've been dividends payable. Okay, if we look at the normal transactions that have happened. Okay, so dividends payable is going down. This is the transaction we're dealing with, and cash is going down. Okay, so this will go, since we are paying cash, we have to go into our cash payments journal. We'll write the date, the account title, dividends payable, check number, dividends payable is debited, cash is credited.